Hello and welcome to this special show. We are talking about the Q1 FY25 GDP numbers, and in fact it has come in line with what the street was anticipating. So the GDP growth has come in at around 6.7% versus a CNBC-TV18 poll of around 6.8%. This compares to 8.2% on a year-on-year basis and 7.8% on a sequential basis. Now the GVA figure, which was expected to actually come in lower, has come in higher than what the street was anticipating. So the GVA has come in at around 6.8% versus a poll of around 6.4%. So 6.8% compares to 8.3% year on year and versus 6.3% the last quarter. Now let's just break it up sector-wise. Agri growth at around 2% versus our poll of around 2.9%. So there's a little bit of come off in terms of agri growth. It is 2% versus 3.7% year on year. So there is a little bit of a come off there. Mining growth has come in at around 7.2% versus 7%. Manufacturing has come in at around 7%. The street was anticipating around 8% this quarter, and this compares to around 5% year on year and 8.9% on a sequential basis. Electricity 10.4% versus 3.2% year on year. Construction has come in at double digits, so that's come in handsomely at 10.5% versus 8.6% year on year and versus 8.7% in the previous quarter. Trade hotels growth, that basically gives you a sense in terms of urban consumption, has come in lower, so it's come in at around 5.7% versus 9.7% year on year. Finance and real estate growth has come in at around 7.1%, so it's cooled off both year on year as well as Q on Q. And public admin and services growth has come in at around 9.5% versus 8.2% year on year and versus 7.8% sequentially. Well, to talk more about all of these numbers, we have with us Dr. Pronab, Sakshi, Gupta, Vice President and Senior Economist at HDFC Bank, and Kanika, Pasricha, Chief Economist at Union Bank of India. Thanks very much for joining in, Dr. Sen, as well as Sakshi and Kanika. Well, I'll start with you, Dr. Sen. What is your sense in terms of the numbers, especially the fact that the GVA has come in a tad higher than the GDP?
Well, that's not unexpected, actually, if you think about it. We are talking about a quarter in which the elections were there. And that's precisely the period when the government itself will go slow on, cracking down on tax collections, hold it for a little while, and would probably release subsidies as far as the election rules permit. So the net indirect taxes are likely to come down during this period. So that's not a surprise. So the good news is that the GVA is looking good.
Okay. All right. Yes, the GVA is looking good. Well, we do have the industries data, which is compiled together now. So that's coming at around 8.3% versus our poll of around 8%. And that compares to 6% same time last year. So there's an improvement there. And it's largely in line with what we did in the previous quarter, which was 8.3%. So which was 8.4%. So 8.3% compares to 8.4% in Q4. Services as a whole has come in above 7%. It's come in at 7.2% versus a poll of 6 to 6.5%. So that's done better than estimates. Services growth as a whole has come in at 7.2%. versus 6.7% in the previous quarter. So there's a pickup in terms of services and versus 10.7% on a year-on-year basis. Sakshi, what's your sense in terms of the overall 6.7% figure that we've got for the GDP?
Well, I think, this is very much in line with what we were anticipating. We were at 6.6. So no major surprises, on this front. I think we have to see this data in some context. One is that I think that some of the distortions that we saw over the last, 3 to 4 quarters in terms of the gap between GDP and GVA, that was expected to come down. So clearly that is something that has played out. Secondly, I think that, it was, we usually see sequential activity slow down in the first quarter of the year. And on top of that, this time you also had the election effect. So there was a lot of wait and watch. So that, that in part kind of explains why you are, moving from a 7% plus number in the fourth quarter to now 6.7 for the first quarter. But overall, this is a healthy number. I think that, the numbers that we are getting on construction, that is where I think a little bit of surprise. The, construction activity shows from the data, shows that it continues to remain strong. We were, in fact, picking up signals from some of the high frequency data that because of the election effect, perhaps there was some slowdown on this front. But clearly the, data that we have today suggests that there is a lot of momentum in the construction sector that continues. So overall, I think, from the supply side, clearly a positive number, of 6.7 on growth.
Okay. Well, Dr. Sen, I'm just going to take that point forward that Sakshi did mention about the industry's growth, the manufacturing growth. Manufacturing is at 7%. We have electricity, which is coming at 10.4%, construction growth, which is in double digits and 10.5%, and mining, which is at 7.2%. Industries as a whole is coming above 8%. What is your sense? Because yes, as Sakshi mentioned, this was a quarter where we were probably going to see the election impact come through in terms of spending as well. In that context, what is your reading on the industry's data?
No, I think Sakshi is absolutely right, except I would interpret it slightly differently, which is that what the election quarter usually has are rules about announcing new projects. But there is a very strong incentive for the government of the day to actually accelerate the ongoing projects. And that's what construction picks up. And because construction has very, very strong backward linkages, it's going to have effects on segments of both mining and the manufacturing sectors. So it's all of one story. So there was an acceleration, it would appear, in infrastructure development on ongoing projects, not new projects. And that I think is the story. And it kind of gets corroborated by when you look at what has happened to government, which is public expenditures. That's gone up very sharply. That's again 9% plus, I think.
Yep. Public admin and services growth is... It's coming at around 9.5%. It's an improvement versus 8.2% same time last year and versus 7.8% on a sequential basis. But Kanika, if I had to get your thoughts in terms of, say, the consumption data, if you look at agri, that's coming at around 2% odd. We have trade hotels growth, which is coming at around 5.7%. Public admin and services growth at 9.5%. What does it tell you about consumption?
So, Ekta, the data is actually showing some healing in consumption demand as well. Actually, very interesting. It's a quarter which is seasonally weak, election quarter. And even when you look at central government spending numbers, on a YOY basis, there was a decline because it is an election quarter. But in public admin, there's a significant share, I think it's around 50-55% of other services as well. That seems to have clocked a very decent pickup, offsetting probably some slowdown on public admin, which is mainly revenue spending by the government during the quarter, which has suffered as per actual data released as well. So it seems that the other consumption, other services, which has tailoring or the smaller services that you have in the economy, it's showing some healing in terms of consumption effect. On the other hand, as you rightly said, agri growth picking up from the kind of lows we saw due to El Nino effects in the second half of last year. It's actually showing some healing. It has corroborated with some healing in rural demand as well across indicators in Q1. And of course, apart from that, trade hotels, it has been led to some extent by urban consumption staying robust or at least staying supported, while rural consumption witnessing a healing impact. So overall, from multi-year lows of just 4% consumption growth last year, some healing likely in consumption demand in Q1 FY25. In fact, we think for the financial year itself, from FY24 to FY25, while there is likely to be a slowdown in terms of actual GDP growth numbers, as Dr. Sen and Sakshi also alluded to, on account of net indirect taxes being much higher last year and the wedge between GDP, GVA being much higher. but the drivers of growth shift from Capex towards some more contribution coming from consumption side in FY25. Thanks.
Okay, all right. Dr. Sen, do you think that the election impact will probably be a little lagged and show in the Q2 data then when it comes to industries?
Again, one of the things we've got to recognize, Ekta, is that the quarterly data is really picking up the information from the corporate sector, by and large, except for a few things like construction. That data will not change very much. The real effects would show up in the MSME sector, whose data we are not going to get till we get the annual results.
Okay, all right. Sakshi, what is your sense in terms of this difference between the GDP as well as the GVA data? Are we now expecting this kind of stabilization to continue into the coming quarters as well?
Yeah, I think absolutely. Of course, we expected the wedge between GDP and GVA to come down in this quarter. Clearly, net taxes growth seems to be negative from, the fact that GVA now is higher than GDP. And I think that, as I mentioned earlier, there is this normalization that is going to happen, and continue. A lot of the distortions, not just related to the difference between GDP and GVA, but I think other things like, we've had deflator issues in manufacturing that pushed up those numbers over the last 4 quarters. So some of these disruptions that we were seeing in the data are now going to start normalizing. And my expectation would be that you start seeing both GDP and GVA, gravitate and range between the 6.5–7% for the coming quarters. Particularly for the first quarter, the data that we are looking at, we were already picking up signals of the fact that subsidy payouts in this quarter were higher than the previous quarter and higher than last year. And the indirect tax collections were lower on a YOY basis. So that explains the fact that you are seeing the gap between GDP and GVA has come down so significantly, and GVA growth is kind of now higher than GDP.
Okay. Well, Dr. Sen, the Capex, what is your reading in terms of the Capex pickup this time? Because there is a sequential pickup which has taken place in the gross fixed capital formation, which is coming at 7.5% versus 6.5% the previous quarter and versus 8.5% same time last year. Where do we stand in terms of Capex?
As far as Capex is concerned, look, in any case, our overall fixed capital formation is running subpar, and we continue to run subpar, even with the very handsome growth that we had last year. And it's a cause of worry. The government has done a lot in terms of its Capex, but the private sector doesn't seem to be responding as much. And if you factor out the construction part of it, then I'm afraid we are still running subpar.
Sakshi, what is your sense in terms of the Capex?
Well, I think, and this is just going by, the data released by the RBI recently on private Capex intentions. And of course, we know that the heavy lifting so far has been done by the government. Over the last, I think, 4 to 5 quarters, there have been segments in the economy where, private Capex has started picking up. Of course, it's been centered around, the construction segment. Clearly that's showing up in the data. But what's encouraging is that I think we are beginning to see some improvement in private Capex intentions. Things are incrementally moving forward, although we are not seeing a full-blown, broad-based recovery where we are starting to see a lot of capacity expansion across a number of sectors beyond construction. So I think that story is still some time away. But clearly, on an incremental basis, things seem to be moving a little bit from where we were, about one and a half years ago.
Okay, interestingly, Dr. Sen, I just wanted to get your thoughts in on the agri growth, which is coming at around 2% it's versus 2.9%. Do you think that the heat wave actually had its impact much more? It was probably much more pronounced than what the street was anticipating. And it is probably something which needs to be factored in. Pranjul Bhandari in the morning made a very good point that it's easy to navigate monsoons because you have irrigation, but it's very difficult to navigate high temperatures, which we are now facing, and the impact that it could have on sectors such as agri as well as services. Your sense in terms of the impact that played out this time?
Again, we need to recognize what the data is capturing. I mean, at the time during the first quarter, you're getting the tail end of the Rabi crop and the sowing of the Kharif. And what is probably happened is that the sowing was delayed because, as you said, of the very, very high temperatures, right? So the 2% growth that is being shown for the first quarter, I don't think is reflective of the growth that you will see in the second quarter, but in particular, when sowing came back with a vengeance. So I think it's just a timing issue more than anything else. And we shouldn't read too much into it at this stage.
Okay. All right. But as we come towards the end of the show, it's time to actually quiz you all on what you all are expecting for the entire fiscal now. Let's start with you, Sakshi. What is your estimate in terms of, what you are penciling in when it comes to GDP? Because the street consensus is it's going to be a sub 7% growth figure. But based on what you're seeing this time round, are you probably reworking those figures?
Well, I'm not rework. I wouldn't necessarily rework my numbers. I think this number was pretty much in line with what we were anticipating. We have a forecast, GDP forecast of about 6.8% for FY25. And as I said earlier, I think in the subsequent quarters, you will see GDP figures between 6.5% to 7% for, the second quarter and also in the second half of the year. I think we are betting primarily on some improvement on consumer demand. I think there's also, green shoots coming in on the export side, both goods as well as services, which are going to be supportive for growth. And at the end of the day, you now have the government coming in and spending both at the center and state level, with the elections and the budget out of the way. So a lot of that spending is going to be supportive for, overall GDP growth. So that's where we kind of stand.
Okay, all right. And just quickly, your estimates in terms of industry or what you are expecting in terms of, say, construction, manufacturing?
Well, for construction, I think we continue to remain positive. As I said, a lot of this is being supported by, continued government spending, this year. So we are positive on that. I think the real estate segment, if you look at it from the credit side, I think the momentum there kind of continues. There seems to be healthy demand. So I think that's another support that is coming in. For the manufacturing sector, I think, demand conditions are going to improve. So, there is some support there. But I think at the same time, profit margins, we've seen from the quarterly results, even for the first quarter, the profit margins have kind of moderated because of the rising input costs. So that's something that we kind of need to kind of watch out for on the manufacturing side.
Okay. All right. What about you, Kanika, your estimate for the entire year, and what do you think is probably going to lead it?
Sure. So, first and foremost, this quarter, our estimate was 6.7. So bang on. Though I would acknowledge that at least on the GVA side, there was actually some upward surprise. We were at 5.8 and the number came in at 6.8. So the wedge, which was 150 basis points between GDP, GVA, March quarter, we thought it'll narrow down to 90 basis points. The numbers come in at just 10 basis points. But on a full year basis, three key trends to watch out for. So on a full year basis, we think the wedge remains almost similar, 10 to 20 basis points. And our estimate for full year on GDP is 7%. So we maintain that number. That's one. Second, the switch on the expenditure side, as I stated, consumption gaining momentum, Capex growth coming down. In fact, if you see for this quarter, the question you asked me earlier, Capex and consumption growth has been broadly similar at 7.5% in this quarter, compared to the kind of wedge we saw in last year. Third, the wedge that we saw in industry and services last year. Industry was leading growth, services were strong but still relatively lower. This year, because of the tailwind from commodity prices, on a YOY basis, the numbers were falling, and that was serving as operating profit growth rising last year. That switch has started to happen. We were surprised it didn't reflect in the Q1 numbers, but at least over the year, that momentum, at least the on-the-ground realities do come to fruition. So switch between services as a major growth driver and industry on a back foot from a GVA side. Thanks.
Okay. All right. And Dr. Sen, you have the last word. Your estimate in terms of what we can probably close the entire fiscal with. The RBI is sitting at an estimate of around 7.2%. What is your sense in terms of where we could close GDP for FY25, as well as your segmental analysis?
My original estimates were pretty much Sakshi's estimates as well. It was about 6.8%. But, the corporate results, which were put out, they've gotten me a little worried. And I am now in the process of actually downgrading my estimate for the current year. And the reason for it is not so much weakening of corporate bottom lines. I don't think that matters as much as what has happened to the top line. It's dipped from, 15 to 17% growth last year. It's dipped to closer to 7 to 8, which is a very serious dip. And that's going to show up. If that trend continues, which is a steady weakening of corporate top lines, it doesn't bode very well. So at the moment, I think I would hedge my bets. And I would say that I still hope for 6.8, but I would probably guess at closer to 6.6.
Okay. All right, 6.6, 6.8%, that's pretty much where the consensus is right now. A sub 7% figure is what we are expecting still in FY25. Well, the headline figure for Q1 FY25 in terms of GDP stands at 6.7%. It has slipped to the lowest level that we've seen since Q4 of FY23. But the internals matter, such as the gap between the GDP and the GVA, which has come down just to around 10 basis points. Dr. Sen, Sakshi, as well as Kanika, thank you very much for joining in and speaking to us on this special show. Thanks very much.